Perfect. Yeah, I can see that's recording now. Lovely.
Yeah.
So thank you for that. So good morning, everyone. Thanks for joining us this morning. My name, you may have seen me on previous webinars, but my name is Kat Barley. I'm the Strategic Account Manager, working with Julian Harris to support you from an Aviva perspective, and I work alongside the account managers that you may speak to regularly. So today, we're here to talk to you again. You may remember we held a webinar for yourselves in January where we had Simon, our Technical Development Manager, talking through the changes we saw in the 2025 budget. And Simon highlighted some valuable financial planning strategies and opportunities for you to focus on in our changing tax landscape. And following that webinar, we saw further demand for some more focus on trusts and taxation of bonds. So that's why we've arranged a further webinar, and we've got Simon here again today to speak to you on this topic. Now, Simon has had some technical difficulties this morning, so he's choosing to keep his camera off just to make sure the technology works and that he can present. You can see his presentation and you'll be able to hear him speak. So hopefully that should run smoothly now when he has his camera off. And as Simon presents, I'll monitor any questions if you want to put them in the chat, and hopefully we'll have some time to answer these at the end of the presentation. And we'll also have our account managers available to follow up with you if you'd like to discuss this topic further at a later date. So with that then, I'll pass over to Simon to take you through our presentation today.
Thank you, Kat, and good morning, everyone. Kat, can you hear me? Just a quick thumbs up.
Yes, I can hear you. No problem.
Yeah. Yeah. So good morning, everyone, and thank you for again having us. And again, apologies. I've had network challenges this morning. I've been accused of being in my pajamas. You have to trust me that I promise you I'm not. Yeah. So as we said, I look after the technical planning within Aviva, working with with Kat, and it's kind of you to invite us back to chat through some more. So today we're going to be focusing on I guess an extension of what we looked at last time, which was the budget and the impact that was going to have. And one of the things that we're already starting to see, and we're talking to a lot of people about, is actually investment bonds, both inside and outside of trust, as a kind of client need and client demand. So as we go through, we're going to cover that topic across a few things, but the focus is going to be very much planning. What I don't want to do is just stand here and talk about a product, because look, let's be honest, no one wants to just listen to a product chat. Interestingly, as we were just opening up the forum, we were talking about how the need for planning and for the human side of planning is just growing and growing and growing. So yes, we're going to talk about bonds, and we're going to talk about the landscape, but I really want to make sure there's loads of opportunities to talk about planning ideas, planning structures. So, if this has been a success for me, if you've got things you think, I could go and talk to that person or that client about this, or actually that's an area that I can go to people about. And as Kat said, any questions you've got, please do throw them out. We're really happy to pick them up. Equally, if there's things afterwards you think, I wouldn't mind kind of exploring that a bit further, absolutely no problem. Please do get in touch with us. So, we're going to look at bond structures. We're going to look at the taxation that we draw, but we're going to really focus on kind of planning and strategies and what it really means for clients. So as we touched on previously, and I think it's important to reiterate this, the key driver of change in this has been the tax landscape that has been here for the last couple of years, or 18 months particularly. There's been lots of bits where obviously tax has been squeezed and been looked at, but for me, the biggest one still remains the 2024 budget. The 2024 budget being, of course, the first one of the new Labour government that was voted in that summer. And it really gave us a good insight into what tax policy was or could look like. And I think largely what we've seen, which was kind of set out by them, is the tax lens or the tax focus is going to be on people who've got assets and who are living off those assets. So, those people with large DC pension pots and investments are going to see the biggest impact. So what are we seeing that's going to impact investment bonds? Well, the first bit is, and look, you'll be incredibly familiar with this by now, is the change to inheritance tax. So there was 3 big changes. The first one is going to be that pensions were brought into the IHT net from 2027. So we've got 11 months until that change comes in, and that's going to be really, really really significant. Now, there's two bits to that I think are really, again, further make it even more significant. One of which is that the confirmation of double taxation. That is to say, the pension will be liable to inheritance tax at the point of death, and then if the client dies after 75, they'll be liable to income tax on withdrawal. Now, that was very, very deliberate. That was very, very deliberate because the Chancellor said quite clearly that they want pension funds to be used as pension funds, not as kind of what they become, which is intergenerational trust funds. So this was really focused in mind. So that double tax, in my view, will do that, because it means people will say, well, I might as well spend it now and pay income tax, because if I die after 75, which surprisingly high number of people do, the taxation position is going to be really, really significant. So in a way, pensions have gone from being the worst or the best to the worst in inheritance tax overnight. We've also seen the freeze in IHT bans frozen until 2030. Then it was subsequently frozen until 2031 in the next budget. Again, that's really, really important because it will give us 22 years of frozen nil rate bans. This is one of those taxes that you don't really realize until after time. As time goes on, people look back and think, my goodness, my tax bill has gone up and up and up. My tax bill's got really, really significant, and my IHT bill's jumped. As assets rise 3, 4, 5, 6% a year, the markets do well, assets grow, nil rate bands stay the same. Before you know it, that gap between your allowances and your assets can grow and grow and grow really, really quickly. So that's an under noticed one and a significant one. And again, it's great for client conversations, which is, let's project forward a couple of years. Let's use cash flow if that's in part of your kit. If not, just do it on a spreadsheet and say, let's have a look. Imagine your assets grew 4 or 5% a year. What would that do to inheritance tax? So those two, I think, are going to be significant for lots and lots of people. The other one is going to be the freeze of the or the restriction of IHT on businesses to, it was $1 million in the budget. It was then subsequently uprated to $2.5 million. So that will again catch lots of people. So for me, that's going to drive an IHT conversation. I think there'll be lots of people who at one point would have said, I'll leave my pension alone and I'll live off my other stuff. They're now going to say, I'll spend my pension and I've got all these other assets that I no longer need that I was going to live off. And that will be, I think, a really common conversation. What do I do with those assets? How can I use gifting? How can I use trust? How can I make it effective? But, the most important bit, I think, here is the role of the financial planner, because, from a spreadsheet, it makes sense. But actually giving away money is a big step for people. Psychologically, it's a jump. It can cause anxieties. It can cause nerves. There's a huge amount there that's going to make people need human advice for someone who can say, I'll look after this journey with you. I'll take you on this journey. So I think we'll see a massive increase in the need for IHT planning. Naturally, I think investment bonds work really, really well for trusts. We'll look at that in a moment, but that demand will be, I think, a lot will be driven by more people doing trust planning. And we've also seen capital gains tax changes, which of course you'll be familiar with by now. Capital gains tax rates have gone up, thus making bonds more attractive relative to GIAs in that perspective. And we've also seen a very, very significant cut in the capital gains tax exemption from once was 12,300 down to 3,000. Now, I think from my experience of talking to lots of planners over the years, the bigger factor here in some ways is clients just don't really want to do a tax return when they've sold they've done for example, if you funded your ISA from your GIA and you've created a gain of £3,200, these kind of things create hassle. And yes, there's a tax side, but there's also an administrative simplicity. So look, I know we've kind of covered that to an extent before, but there is a lot going on. There's a lot of change. There's a lot of need. But, let's not forget, this is going to create masses of opportunities, masses of demand for really, really good long-term holistic financial planning. This is, I think, an opportunity to deliver real value. So let's move on to looking at investment bonds. As I said, I think we'll see some in trust, some outside of trust. before we get into the planning, just really high level, you'll be familiar with this, I'm sure, but an investment bond is a life assurance policy, and it's a life assurance policy that is ultimately designed to create an investment. So yes, it's life assurance, but ultimately it's an investment. It does come with a life assurance amount, but really for most people it's about investing. The key thing, and we'll look at some sort of benefits in a moment, but the key thing is you don't have an investment bond, you actually have 1,000 investment bonds, and we'll look what that means from a flexibility perspective shortly. But it's it's a really flexible way of investing inside and outside trust. So where does it work? How does it work? Well, I think there's a couple of key things, and let's think about in trust first, and then we'll think about outside of trust afterwards. But inside a trust, really, really important, because most trustees are not professional. Most trustees are just regular people who it's not their job. They're not solicitors, they're not accountants, they're not trust companies. They are just regular people who are looking after a trust for their, for the family members. So what they want is simplicity, and that's where a bond really works, because it gives the trustees control over the tax. If you've got a GIA and it creates some dividends, they need reporting. If there's some savings income, they need reporting. If you switch a fund, a quarter capital gain, it all needs reporting. An investment bond allows control over the gains. So while it's growing, while it's invested, you've got the ability to have much simplified reporting. You've also got the ability to use that 5% tax deferred allowance. That is, I think, still a really, really key benefit. It allows you to create an income inside or through a trust or out to beneficiaries or to a settlor without creating chargeable events. Again, that's a really, really important part. You're not creating chargeable events, which is super important. And you've also got the ability to assign in and out of trusts, because what do people not like about trusts? Well, one of the bad things is the tax rates inside the trusts can be punitive, 45% for the most part on income, and the highest rate of capital gains tax as well. So it can be quite punitive. A bond allows that control. And that's really important, because obviously if you've got a trust with a deceased settler, you don't really don't want to be paying creating gains at 45%. The bond allows you the ability to assign. So it's really effective. It's a really nice tool to say, we can invest, we can get the money growing, we can create an income stream, but ultimately we've got tax control. So we're going to wait and we're going to defer that gain until it's in the hands of the right people, giving you, a great outcome for many clients. So let's have a look. Let's move on now to start to look at the taxation, because this is the bit that's really important. Yes, you can grow the money. Yes, you can invest it in a trust. And yes, those things are really, really effective. But the key comes where people want to take money out. That's the key thing. Now, an investment bond gives you two really, really important ways, or actually there's two main ways, but you can obviously combine them. But there are two fundamental ways in which you can take money out of a bond. The first is partial withdrawal. So you can say, if you think back that the bond has got 1,000 segments or 1,000 mini bonds, you can take the little bit from each and every bond. So we'll look at that. So you can take it equally across all of your segments. Think about that almost as kind of horizontal, or you can sell one or more individual segments. So think about that as vertical. So we'll look at the two, because understanding this is, I think, really key to delivering great outcomes for clients. So as I mentioned, a bond gets a 5% tax deferred allowance every year. So day one, you get one. Year one and a day, you get your second one. So you get 5% of the original investment, and that accumulates. So if you don't use it, that rolls up to the next year. And once you've taken that, anything you take in excess of that is treated as a chargeable gain. So if you had £10,000 of tax deferred allowance and you took £20,000 out, you'd create a £10,000 gain. Now, this is the bit that clients sometimes scratch their heads about, because it has nothing to do with performance or profit or anything like that. So it doesn't matter how much increase or decrease the value has gone. It's just a case of, if you take more than your 5% allowance, anything you take above that is going to be treated as chargeable gain. Now, there's one other nuance here, which is since RDR, any ongoing advice fees taken from the bond will be treated as a withdrawal. So they will use up part of your 5% allowance. So that's just one to be careful of. And then the other bit, which is a funny way that it's calculated, is the gain that you create is always treated as arising on the last day of the policy year. That's because, of course, you don't know what the gain is going to be until the last year, because you might take out some more. So every year, at the end of the year, whatever the excess is, that arises at that date. Now, the important thing to remember here is that may or may not be a problem for a client. So, for example, if they are retiring next year, they might use this to their advantage because they can defer that gain into next year when they're a lower taxpayer. But equally, if they're in a year out or year off and they want to wait till, and they take the money now thinking, great, let's get the gain out now, you can sometimes get it mixed up. So it's really important to not just understand what the gain will be, but when it will arise, and generally top slicing will be available. So let's look at an example which brings it to life, I hope. So Mr. Smith put 200k into an investment bond, as you can see, and the bond was made with 1,000 segments. He made a partial withdrawal in 2023, and then August 2025, he took another £70,000. The bond is worth 280, and for simplicity, we're disregarding advice fees because it makes the numbers really complicated, but the principle is as you'll see. So we're saying that his 5% allowance is a straight 5% of his £10,000, of his £200,000 investment, i.e. £10,000. So we're going to look at two things. We're going to look at what the chargeable gain is at the two withdrawal points, if anything, and number two, if there is one, which tax year would it fall into? So let's have a look. Let's bring this example to life. So when he takes the first withdrawal in July 2023, he's actually in the fourth policy year. So policy year one is June 20, June 21, June 22, and June 23. So he's in the fourth policy year. So he has 4 lots of £10,000, i.e. 40,000. He's not used any before, so he's got 40 available. He takes 15, and his excess is 0. So at that point, he's taken £15,000 and not created a chargeable excess. So again, really, really useful for someone who wants to take money out and not pay any further tax on them. Let's now move on to looking at the withdrawal in August 2025. So as you'll appreciate, there's been 2 more years have passed. So he's into year 6 by now. He's got £60,000 allowance because it's always 10%, so 5% of the initial, the value increase or reduction is irrelevant. So he's got £60,000 available. He's used 15 2 years previously. So therefore, he's got £45,000 allowance. He took 70, and therefore the excess is £25,000, and that arises on the last day of the policy year, which actually is in the next tax year. So in this example, the gain arises in the next tax year to the one that he actually received his capital. So again, just one that might be a problem, or it might be advantageous depending, of course, on his tax rate, but he just needs to be aware of that. So that's option A. You can take a partial, and we'll look at some examples in a moment about when that works, or when that's potentially not as attractive. The second option is you think about this as vertically, which is selling full segments of your investment bond. So she's got 1,000 segments, and each one is identical, and you can sell them. So when you're looking at this route, this is more straightforward and makes more logical sense to many clients, because what this looks at is how much profit has the client actually made. So on the left-hand side of the equation, you've got what they've got out of the bond, which is the surrender value plus any previous chargeable withdrawals, previous partial withdrawals. Now this is important because you'll notice they're called tax deferred allowance, not tax free allowance. It's called tax deferred because the gain will that withdrawal will ultimately come back in at the point of final calculation. So what they've had out, and then you take off the purchase price naturally, plus you also take off any previous chargeable excesses. The reason for that is to avoid double tax, because those previous excesses would have been assessed to tax and it would be unfair to charge you again on them. So let's look at an example to bring that to life with Mrs. Jones. Now, Mrs. Jones did very similar to Mr. Smith. She put 200k in a bond, and in June 20 with 1,000 segments, and she also made a partial withdrawal in July 2023 of 15k. Now, if you remember from the last one, there's no chargeable event on that. That's nice and straightforward. Now, for her, it's now August 2025, and she wants to sell the entire bond. She wants to take her money out, and it's worth £280,000. So let's look at those two questions. Again, what, if anything, is a chargeable gain? And question 2, what tax year would that fall into? So you'll be pleased to know this is fairly logical and as you'd expect it to be. So what she had out of the bond, she's had the sale proceeds of 280 plus a 15k chargeable, which totals 295, and you minus the £200,000 investment, and she's not had any previous chargeable excesses, so therefore she's made £95,000 gain. Now, for simplicity purposes, she's actually made £95,000 profit, so it feels kind of right, which is good. She has made some return, and that money is going to be as taxable. Now, because, or assessed to tax at least, because she sold her bond on the 1st of August, that ends the policy. There's nothing left, and therefore the gain arises on the 1st of August inside that tax year. Again, really, really useful. Really, really useful because she knows exactly when it's going to be, and it gives her that planning opportunity. So, as I said, there's two ways you can take money out. There's also, of course, any combination of the two. Any combination of the two is possible, because you might say, well, I'm going to sell X number of my segments, and for my remaining segments, I'm going to take the rest as a partial. So there's loads of flexibility for clients. It's really nice for kind of real world planning for clients who want to do that. So what else could and should they be thinking about? There's two ways to do it: segments or partials. Which one is better? The answer to that, of course, is it depends. But there are a few things to think about. There's never a right or wrong immediately. There's lots to think about. The first one, which is fairly straightforward, which is which option, of course, creates the smallest gain. A partial, if you've been running for a long, long time, you've got lots of 5% allowance, a partial might be more effective. If your bond has not made much profit, sometimes a segment surrender will be better. So looking at gain is first. Second of all, which one creates most top slicing? There are some funny nuanced rules around top slicing, one of which is where you've created a partial gain previously and you create another one, you can only top slice back to the previous gain. So sometimes you might decide to look at a segment surrender because the top slicing is greater. It's also important to think about the future. The future plans for that client. This is where I started by saying, ongoing financial planning advice is really important here, because if you make a partial surrender, you've still got the same amount of segments. Again, that's really important because it means that your 5% allowance in the future is not going to be reduced. Therefore, if you're keen on taking income in that way in the future, you might be well advised to keep the segments in place. There is an interesting planning opportunity where you've got clients who have got an onshore bond and are basic rate taxpayers, because if you create a chargeable event, as you've seen from the calculation, when the bond is ultimately surrendered, so if you create a partial, go above your 5% allowance, create a chargeable event, that will, at the end of the bond, act like a debit effectively against the growth. So, if you create a £50,000 chargeable event that you top slice into the basic rate, there's no tax to pay. When you come to sell that bond, the ultimate gain will be reduced by £50,000. That can be effective if you're taking money out at a time where you're a lower taxpayer, when you may be higher in the future, or you're passing it on to someone else, or there's lots of reasons. But sometimes it can be no bad thing to create a gain if it doesn't create a tax charge. And also thinking about the future, who is it best who is best to use that 5% allowance? If I'm a non-taxpayer and I'm burning through the 5% allowance in the knowledge that my higher rate tax-paying kids will be getting the bond eventually, it may not be the most sensible thing to do. It might be better to leave them the 5% allowance. That might be the most effective means. So lots to think about, no rights and wrongs, but the need for advice for me is really, really important. And what else is there to think about? Well, there's lots of challenges to get in to consider. The first one is back to that point, the need for ongoing advice is really, really significant, because if a client wants their money all of a sudden and they've got a bond that's been running for a long time, and they just say, well, we're going to buy a holiday home or a camper van and I need the money in 3 weeks' time, the chances are they're going to get a significant tax charge if they've got a lot of growth. It all goes into one tax year. It might impact personal allowance. It might take them through tax rates. There's lots to think about. If they think carefully and long term and think, well, actually, in a year or two's time, I want to do that, it gives you the ability to drip it out over a couple of tax years. One I think is hugely important here to be careful of is those people who have investment bonds with lots of gains, that they're the last life assured. When they die, the bond will end, all of that gain will arise in one tax year. Whereas there's some opportunity to do some really good planning, which is, you're the last life assured, adding lives assured on the bond. I won't go into the detail because it's really, really complicated, but largely it turns out worse than a full surrender, and most providers don't allow it in any case. Adding lives assured is a bad thing. So rather than having on your death, it all arises, let's strip it out over 2 or 3 tax years. Let's use top slicing. Let's get it out without further tax and then reinvest in a way which is going to be appropriate for that client, depending on their circumstances. There's also that question about getting it in the right taxpayer's name, particularly within spouses. It does happen where, the higher rate taxpayer's got the investments and they're just about to make a surrender. That can be a big one. And then the other one is a discretionary trust holding a bond that's owned by a deceased settlor, where the deceased settlor has got money and has set the trust, the settler's deceased. Any investment bond gains will be assessed at the trustees' rates of 45% following the tax year of the settler's death. So when you get to the next tax year. So again, clients won't often realise that. They'll think, we've got the bond, mum or dad died a couple of years ago, let's just sell it, let's get the money out. That's a big one. I've seen that a number of times. That's a big risk. And again, a simple solution, as we'll see in a moment. So what kind of ideas and opportunities are there? They're basic things, but they're basic hygiene things that doing well will make big difference to clients. Is the right person owning the bond on surrender? That can be easily rectified. As I mentioned, multiple tax year planning is a really great opportunity. It's easy to do, it's straightforward, but it requires foresight and forward thinking, which, if you're there advising clients, is a real big value add. Thinking about who to surrender is an important one as well, because if the client wants to give some money to their kids, if the client's a higher rate taxpayer and the kids are at university, it probably makes sense to assign the bond to them. If the kids are high-flying, high additional rate taxpayers and the parents are retired on state pension, it probably makes sense to sell the bond and give them the cash. Again, it's very circumstantial, but there's lots of opportunity. And then again, the big one to watch out for is planning with trustees, either because the settlor is deceased, which is often the case, and therefore making sure the money is assigned out of the trust prior to surrender is going to be really, really important. So we've covered quite a lot over the last kind of 35 minutes or so. Hopefully you've seen that, as we touched on originally, that the planning world has changed a lot. And I think the area we're going to see the most significant growth really is going to be around inheritance tax and estate planning. I was chatting to a director of a large network a few months ago, and she was saying that she reckons that the number of their clients who've got IHT liabilities is going to go from 1 in 8 to 1 in 3 when the pension comes in. So it's going to be really, really significant. And the sort of planning around trusts, around gifting, around CLTs, around pets, around order of gifting, periodic charges, exit charges, comparing different trust structures, all those things that once were a more significant part of financial planning, I think will come back to the fore. The brilliance of pensions in some ways has masked, arguably has masked some of the IHT challenges we've seen to date. And as of 11 months' time, that's going to go for a lot of clients. So lots and lots to think about. As I say, trust planning, I think, is more important than ever. And as I said, the demand for and value of really, really good financial planning advice is just going to grow and grow. And we at Aviva are here to support you as much as we can through Kat and her team. There's lots we can do. If you want to cover some more on trust wrappers and periodic charges and exits and order of gifting and all that kind of stuff, we've got lots of material. We're growing my technical team inside of Aviva, so we're going to have a significant team, and we're going to be here to support you as much as we possibly can. So we've covered a lot of content. I trust there was some things that you were able to take from that. Apologies, my camera was not working, so I'm on phone 4G, I'm afraid, but hopefully that all came through and there was something you could take away. So all that leaves me to say is thank you very much for the invite again. We genuinely appreciate you inviting us along to your meetings. And I'll just hand over to see if there are any questions.
Thank you, Simon. We don't have any questions in the chat right now, but if anyone does have anything they'd like to ask, feel free to put it in the chat or pop your hand up. And if you want to actually speak to us, feel free to do so. Come off mute. I'll just give everyone a minute in case there's... Oh, we do have a question from Dan. Yeah, go ahead, Dan.
Hi, this is a question for Simon, please, if you don't mind. Thanks
Sure.
for the great presentation there, Simon. Just a quick query regarding the actual chargeable gain formula calculation. When you consider all previous partial withdrawals and previous chargeable gains,
Yes.
Presumably you're only doing that since the last full segment surrender, not for the history of the bond's duration.
Yeah, it's a good question. So so what would happen is you would do it for the remaining segments. So for example, if you had, let's call it 100 segments, and you took a partial in year 1, for argument's sake, and then year 5 you sold 20 segments, that would take into account the partial that was taken from those segments. But then in 10 years' time, if you sold the rest of the segments, the partial that came from the segments that no longer existed are ignored. It's only the partial that was attributable to the segments that were there at the time, if that makes sense.
Right.
So if you think about it as 1,000 separate bonds, so if you took £1,000 out, you actually, as a partial, you took £1 from every bond. So whichever segments you're then surrendering, the history of that bond remains. But once that bond's been sold, that will be no longer included in the calculation because it wouldn't exist anymore.
Yeah. So whilst the withdrawals don't count since the previous full segment surrenders, the initial for the initial proceeds always will, won't they?
They always will, yes.
So it's a bit one-sided when you're trying to do the calculations manually, that you got to remember that the initial never changes regardless of how many full segment surrenders there've been, but the withdrawals and previous chargeable gains do decrease as and when you make full segment surrenders.
That's right, because you've got fewer segments there that are remaining, because the 5% allowance is actually per segment, not per the actual bond. So as you sell some of the segments, you've got less 5% allowance, and obviously the history of those segments that's gone is then subsequently disregarded.
Yeah, brilliant. Okay, that makes sense. Thank you.
No problems.
Lovely. Thank you for your question, Dan. And we've just had a comment in the chat, and Gerald will arrange for someone to call you Friday as requested. Does anyone else have any questions, or if there's anyone else that would appreciate a follow-up call, just pop a note in the chat, or our account managers will probably follow up with you anyway, just to check if there's any follow-up questions. But I'll give everyone just another few seconds if anyone else wants to speak. No, seems like there's no further questions then. But again, our account managers are on hand to follow up with any conversations you want after this session. If you want to delve a bit deeper into the topic, we also have Simon's expertise, on hand with any more in-depth questions you might have. He can support our account managers with answering those also. And if there's anything else you need that's Aviva related, we're always on hand for that also. But thank you all for your time today, and yeah, it's much appreciated that you're allowing us to speak to you on this topic, and hopefully you've gotten some value from it.
Thanks,
Great.
everyone.
Thanks,
Bye now.
Simon. Thanks.
Cheers,
Thanks for
bye.
your webinar. Thanks, Kat.
Thank you.
Thank
Cheers.
you. Bye. Have a good
Bye-bye.
day.
Bye-bye. Bye.
Sorry, Mohan, I don't know whether you're going to get sent a copy of those slides. Presumably you'll circulate them if you do get them.